Let me start with a statement that will make every insurance agent furious. Term life insurance is a waste of money. That is right. The product that almost every financial expert tells you to buy, the product that is cheap, simple, and recommended by everyone from Dave Ramsey to your uncle, is actually a terrible deal for most people. But only if you do one specific thing. And almost everyone does it. They buy term life, they pay their premiums, and then they forget about it. 20 years later, the policy expires, and they have nothing to show for it. They wasted thousands of dollars. But here is the secret. If you do the opposite of that one thing, term life becomes the single greatest financial tool you will ever own. By the end of this video, you will know exactly what that one thing is, why it makes term life either brilliant or stupid, and how to turn a simple term policy into $1 million retirement asset. I will show you the math of buy term and invest the difference, the mistake that 90% of people make, and the simple habit that turns a wasteful expense into wealth. This is not about selling you whole life. It is about teaching you how to use term life the right way. Let me start with the one thing that makes term life a waste of money. The one thing is buying term life insurance and not investing the difference. That is it. That is the entire secret. Term life insurance is cheap because it has no cash value. You pay a premium, and if you die, your family gets paid. If you do not die, you get nothing. That is pure protection. It is like renting an apartment. You pay rent, you get a place to live, but you do not build equity. If you rent for 20 years and then move out, you have nothing. That is what most people do with term life. They pay premiums for 20 years, the policy expires, and they have $0 to show for it. That feels like a waste. And it is. But here is the pattern interrupt that changes everything. Term life is not supposed to give you money back. It is supposed to protect your family while you build wealth elsewhere. The problem is that most people do not build wealth elsewhere. They buy the term policy, pat themselves on the back, and then spend the money they saved on a nicer car or a bigger TV. The money they saved by not buying whole life disappears into lifestyle inflation. That is the waste, not the term life itself. The missed opportunity to invest. Now let me give you the math that proves the point. A healthy 30-year-old non-smoker can buy a $500,000 20-year term life policy for about $30 per month. That is $360 per year. A whole life policy with the same death benefit would cost $300 to $500 per month, or $3,600 to $6,000 per year. That is 10 to 15 times more expensive. The difference is huge. If you buy term and invest the difference between the term premium and the whole life premium, you come out ahead. Let me show you. Assume you buy term for $30 per month. Assume you would have paid $400 per month for whole life. The difference is $370 per month. If you invest that $370 every month in a simple S&P 500 index fund, earning 7% per year, after 20 years, you will have over $170,000. That is your cash value. That is your wealth. That is far more than the cash value of any whole life policy. And you still had the same $500,000 of life insurance protection the entire time. Term plus invest beats whole life every single time. So why do so many people fail at this? Because they do not actually invest the difference, they spend it. That is the one thing. If you buy term and then treat the savings as free money to spend, you are wasting your money. If you buy term and then automatically invest the savings into a low-cost index fund, you are building wealth. The insurance is not the problem. Your behavior is the problem. Let me break this down into 3 segments. First, I will explain the buy term and invest the difference strategy in detail. Second, I will show you the common mistakes that ruin the strategy. Third, I will give you a step-by-step plan to implement it correctly. Segment 1. The buy term and invest the difference strategy. This is not new. Financial advisors have recommended it for decades. The logic is simple. Life insurance is for protection, not for investment. Whole life mixes the two and does neither well. It overcharges for protection and underdelivers on returns. Term life is pure protection at the lowest possible cost. The money you save by buying term instead of whole should be invested separately in assets that actually grow. Over time, your investment account will grow larger than the cash value of any whole life policy. And when your term policy expires, you no longer need life insurance because you have accumulated enough wealth that your family is self-insured. That is the goal, not a payout at death. A life of wealth, let me give you a real example. A 30-year-old couple buys a 20-year term policy for $1 million. The premium is $50 per month. Instead of buying whole life, they invest the extra $400 per month into a Roth IRA. After 20 years, at 7% returns, they have over $200,000 in their Roth. Their kids are grown. Their mortgage is paid. They no longer need life insurance. They have built wealth. If they had bought whole life, they would have paid $450 per month for 20 years, and the cash value might be $100,000, and they would have paid taxes on the gains. Term plus invest wins. Segment 2. The common mistakes that ruin the strategy. Mistake number 1 is not investing at all. You buy term, you save money, and you spend it on lifestyle. You go on a nicer vacation, you lease a nicer car, you upgrade your TV. That money is gone. You have no wealth at the end of the term. That is the waste. Mistake number 2 is investing in the wrong things. You put the savings into a savings account, earning 0.1% interest. After 20 years, you have a few $1,000s. That is better than nothing, but it is not wealth. You need to invest in assets that grow. Low-cost index funds. A diversified portfolio. Do not be afraid of the stock market for long-term goals. Mistake number 3 is not increasing your investments over time. As your income grows, you should increase the amount you are investing. If you only invest the difference between term and whole, you are missing out. You should also invest additional savings as your income rises. Mistake number 4 is buying too short of a term. A 10-year term policy is cheap, but it expires when you are 40. You still have kids in high school and a mortgage. You need coverage until your dependents are independent. For most people, a 20 or 30-year term is the right choice. By the time it expires, your wealth should have replaced the need for insurance. Segment 3. Your step-by-step plan to get term life right. Step 1. Determine how much life insurance you need. A common rule of thumb is 10 to 15 times your annual income. If you earn $100,000, you need $1 million to $1.5 million in coverage. Step 2. Shop for a 20 or 30-year term policy. Use online comparison sites. You can often find a 20-year term for less than $50 per month for a healthy 30-year-old. Step 3. Set up automatic investments. Open a Roth IRA or a taxable brokerage account. Set up an automatic monthly transfer equal to the amount you saved by not buying whole life. If whole life would have cost $400 and term costs $50, set up a $350 automatic investment. Step 4. Invest in low-cost index funds. A simple S&P 500 index fund is fine. Do not try to pick stocks. Do not pay high fees. Step 5. Increase your investments every year. When you get a raise, increase your monthly investment by half of the raise amount. Step 6. Review your insurance needs every few years. As your wealth grows, you may need less insurance. You can reduce your coverage or let the term expire. Now let me address the objections. Some people say that term life is risky because you might outlive the policy and then be uninsurable. That is true. If you develop a serious illness during the term, you may not be able to buy a new policy. But if you have followed the invest the difference strategy, you have built wealth. By the time the term expires, you should have enough savings that your family does not need life insurance. That is the whole point. You are self-insured. Another objection is that whole life is for savings. For people who lack discipline, whole life forces you to save because you cannot stop paying without losing the cash value. That is true. If you cannot trust yourself to invest the difference, a whole life policy might be better than nothing, but it is a crutch. Better to build the discipline to invest on your own. Another objection is that term life premiums increase as you age. That is why you lock in a level term for 20 or 30 years. The premium stays the same. By the time the term ends, you are older, but you should have enough wealth that you do not need more insurance. Let me give you a real-world example of someone who did this right. A couple in Ohio bought a 20-year term policy for $1 million when they were 30. Their premium was $60 per month. They invested $400 per month into a low-cost index fund. By the time they were 50, their investment account had grown to over $200,000. Their kids were out of college. Their house was paid off. They canceled their term policy because they no longer needed it. They had turned a simple term policy into a $200,000 asset. That is not waste, that is wealth. Now let me talk about the UK and Canada. In the UK, term life insurance is also the most common type of life insurance. The same principles apply. Buy term, invest the difference. The UK has attractive tax-efficient accounts like ISAs that are perfect for this strategy. In Canada, term life is also widely available. Use your TFSA and RRSP to invest the difference. The math works the same. Let me recap the key takeaways. Number 1. Term life insurance is a waste of money if you buy it and do not invest the savings. The waste is not the premium. It is the missed opportunity. Number 2. Buy term and invest the difference. The difference between a term premium and a whole life premium can be hundreds of dollars per month. Invest that difference. Number 3. Use low-cost index funds. Historically, they return 7 to 10% per year over the long term. Number 4. A 20 or 30-year term policy is usually the right choice for families with young children. Number 5. By the time your term policy expires, your investment account should be large enough that you no longer need life insurance. That is the goal. Number 6. If you